This is the Asia Trade. I'm Haidi Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. The FBI is investigating a terrorist attack after a pickup truck drives into a crowd of New Year revellers in New Orleans, killing at least 10 people. South Korea's political crisis takes a new twist, with the acting president rejecting his advisor's latest bid for a mass resignation. And a subdued start to 2025 ahead for Asian stocks after Wall Street continued its year-end pullback. Donald Trump's return to the White House dominating this year's investment outlooks. Well, the FBI says it's investigating a terrorist attack and hunting possible accomplices after a truck was deliberately driven into a crowd in New Orleans, killing at least 10 people. For more, let's bring our US managing editor, Miles Miller. Miles, what do we know in terms of the ongoing investigation and what actually happened?
Yeah, so we know this happened 3:15 in the morning in New Orleans. What we're told by the FBI is that right now that they've revised the death toll to 12 people dead and 30 people injured. What we know is that the suspect, Shamsud bin Jabbar, was from Texas, a 42-year-old man. We're told that he got into a rented car that he had rented from someone online from Texas and drove into a crowd of people at high speed. And then after that, he had improvised explosive devices in his car as well. But after he got out of the car and was confronted by police, it was then when police opened fire. We know that the suspect, a 42-year-old from Houston, Texas, had spent 10 years in the U.S. Army. On that car that he drove, that pickup truck that he drove into that crowd of people, well, we're told there was an ISIS flag in it as well. We are told by the FBI that it is believed that he was working with others to both plan and carry out this attack. And the reason that they say they know that is because they found several improvised explosive devices in different parts of the city, including the French Quarter, which is not far from where this vehicle ramming attack happened. And they saw at least 4 people being involved in that, in planting those devices. All of those devices were safely detonated by police, and they believe that this was an incident that was certainly terror, and that's the words that they're using in this incident.
And they said pretty early on, authorities that is, that they didn't believe the suspect was working alone. What do we know about that?
Yeah, based off that surveillance video, they were able to determine that the suspect was working with at least 3 men and 1 woman. And so what they're going to be focusing on in this investigation, which is very early at this moment, is was there planning involved in this? Was there any outside money that went into funding this attack? Now, when you talk about what was in the vehicle, specifically the improvised explosive devices, that shows a level of planning. You know, in some of these devices, authorities were able to figure out that these would have been devices that could have been remotely detonated, which could, you know, if he never was stopped there on Bourbon Street, could he have gotten away and then detonated these devices and caused more terror, more than what he caused early this morning. What we also are going to be looking at is just what led him to what authorities say is self-radicalized. This is a person who spent 10 years in the U.S. military and then quickly, within the time since he left, honorably discharged from U.S. Army, has carried out a terrorist attack on one of the biggest New Year celebrations that happens in the United States. I mean, Bourbon Street's always packed with people, no matter what time of year, but specifically on New Year's, they do a big celebration there in that city. And then, what authorities are going to look at is, was there a connection? There's a bowl game. The Sugar Bowl was supposed to happen at the Superdome. Was there going to be a larger attack planned? And so while they paused the game at the Super Bowl Superdome today, they'll be looking into, was that part of this as well? Were they planning on something bigger? And more importantly, to figure out where those people are who helped plant those devices and figuring out where they are, if they're still in the city, and bring them to justice as well.
And obviously such a fast developing story as well. We're just hearing that update from the FBI saying now there are 15 people confirmed killed in that New Orleans attack. And at the same time, we're also monitoring the situation with the Cybertruck that exploded outside the Trump Hotel in Vegas, right? What can you tell us about that?
Yeah, 8:40 this morning in Vegas, so 8:40 Vegas time at the Trump Hotel in Vegas. We understand that Cybertruck exploded. We know one person was dead in that incident and 7 people were injured. Right now, we know the FBI is investigating this as an act of terror. We know that there are some similarities between the two incidents, the one that happened in New Orleans and this one in Vegas, but they do not right now believe they're linked. And the only similarity is that these were both vehicles that were rented on the same platform, which is a platform where you go on your phone, you can rent a car from someone who owns a car, and that's what happened in both of these incidents. Both of these cars were rented by people who purported to want to take the car out and do whatever they wanted to do personally, but instead cars used in 2 incidents and what officials believe are both acts of terror.
Our US managing editor for Bloomberg TV, Miles Miller, there with the latest on those incidents that have marred, of course, New Year celebrations across the US. Let's take a look at how we're setting up when it comes to this pretty slow return to action for markets around the region. In fact, we do get that late start for South Korean markets, and also Japanese as well as Kiwi markets are still closed for holidays. We are seeing a little bit of upside there, about 1/4% when it comes to trading in Australia. Not a strong lead, as we saw that sort of whimper of an end for US stocks there. Closing out that best 2-year stretch since 1998, but a bit of weakness going into the year end. We're watching those property stocks in particular in Australia, as we have had that decline in home prices for the first time in 22 months. S&P futures, though, opening to the upside there. Nasdaq futures also up by about 0.4%. We do see the S&P 500 currently trading just under that 50-day moving average, just about 18% of stocks in that previous session above that 50-day moving average as well. But we are still looking at that 23% gain this year. Also watching oil at the moment, about 0.3% higher. But broadly, little change as we continue to kind of be pretty range bound for energy prices. Well, Donald Trump's return to the White House is dominating this year's crop of investment outlooks published by the world's major banks, advisors and asset managers. For more on what Wall Street expects in 2025, let's bring Garfield Reynolds, who leads our Markets Live Asia coverage, and Bloomberg's Australia and New Zealand economy editor, Michael Heath, is along with us. So, Garf, I'll start off with you, sort of trying to pass through the risks and expectations. There's a pretty strong camp that kind of expects that 2025 will bring more of what we saw in 2024.
Yeah, very much so, Heidi. And you look at the two key asset groups, bonds and stocks. Bonds had a very muddled 2024, and a lot of the risks are still there, including for stronger US growth, including for increased bond issuance, helping to put upward pressure on yields. So that makes bonds both defensive and very much also a defensive asset, because you do at least get income by putting it in bonds. And while there's some upside in yields and therefore downside in prices, it's probably not going to be enough to really turn those into a major loss. Meanwhile, equities, they benefit from that strong growth. They maybe even benefit from investors' capacity to hedge to some extent by putting some money into bonds and going large on stocks, because there's a very strong constituency that sees the policies that Donald Trump and the Republican majorities are likely to pursue as being pro-growth, pro-stock, low regulation, lower taxes. All of this is meant to feed into equities, send them higher. And while there may be plenty of risks when it comes to execution, we saw the rather chaotic incident at the end of last year when it came to the debt ceiling and so on. Those execution risks aren't seen as outweighing the likelihood of all those other drivers that are set to send stocks higher. When you think about it, last year there were a number of bumps in the road, especially in August. We had a very strong sell-off when the AI theme suddenly became doubted to somewhat. That passed within about a week or two, and stocks marched higher. So I think we might see some of those dips, but those dips are going to be bought.
Some of those bumps in the road were these extraordinary geopolitical developments, right? 2 wars. And yet we saw just that sort of muted market reaction broadly. What's the sort of expectation? It's been a bit quiet. Of course, a lot of that could change depending on what foreign policy from a Trump administration looks like.
Yeah, I mean, that's the key question, I guess, Heidi. And it does feel like we're sort of at an inflection point geopolitically. I mean, it has quietened down in the Middle East of late, of course, except in Gaza. But Iran is sort of licking its wounds. It took quite a hammering. We've obviously got the ceasefire in Lebanon with Hezbollah. But nonetheless, there's still no signs. There'd been talk that maybe there'd be some sort of deal between the Israelis and Hamas to release the hostages, to release some Palestinians, to bring an end to the conflict. But again, as before, that seems to have sort of fallen away. And so, there's a lot of talk about, Hamas must release these hostages, or there'll be even more devastating military attacks on Gaza. I mean, I'm not sure how much more they can really take there in terms of military attacks or what difference it would make. But at this stage, Israel does feel quite ascendant there. And then you've got Syria with President Assad obviously now in Moscow, and everyone's sort of waiting to see how that unfolds. But with Iran having been pushed back, what sort of comes to the fore there is Turkey, because Turkey has the connections with the new government. It had been a supporter of that group. Potentially, for the first time since the Ottoman Empire, we see sort of Turkey with a stake in Syria again, which sort of wasn't on anyone's bingo card, I think, even a month or two ago. But then, by the same token, you've got the Kurds out there with Turkey and the US potentially clashing, because one opposes, one's fighting the Kurds, the other is using them. The US is sort of backing them as their player in Syria. So a lot of uncertainty, obviously, in the Middle East, and then President Trump there, who comes in on top of it. Then you go across to Ukraine and Russia, and it sort of feels like the world is moving in Russia's direction with Donald Trump there. In France, you look at Marine Le Pen, who's seems to be on a roll as well. Whether she ends up winning office, we'll have to wait and see. Obviously, there's still some time there. But none of Donald Trump sort of never actually had to negotiate with Vladimir Putin, and so he seems to have sort of his view of what Putin wants, but the reality, I think, he's going to find is quite different. And what's been floated sort of in the background from the Trump camp is this deal that would see Ukraine's, any ascension to NATO be put well off into the distance, that the conflict freezes where it is, and that but there'd be European and British peacekeepers put in. Now, Russia's foreign minister just came out and said there's no way that's happening, and we know why, because Russia is quite keen for this conflict to either free, for NATO to be off the agenda, and to either freeze the conflict, which means that Russia can come back and have another go at some time, or to allow it to keep going. Russia has all these North Korean troops in now. It has more weapons and ammunition coming in from North Korea, so it's on a little bit of a roll there. And they know that Ukraine's going to lose US support, or likely to lose US support. So there's nothing in it for Russia at the moment to come to a compromise. Whereas President Zelensky in Ukraine, Ukraine looks like it's starting to buckle. It's struggling with manpower. It's going to be struggling with resources, and so it sort of looks like what for the West would normally look like our side, or the good guys, are going to struggle quite a lot.
It was interesting, there were some questions over the past year about the strength of the friendship without limits between China and Russia, right? In that New Year's message from Xi to Putin, they talked about walking along hand in hand. How much do you watch that sort of relationship in terms of the potential influence on, some of these other broader factors that we're looking at?
Well, yeah, China is, I guess, China is the fascinating question here, because whereas with Russia, in many respects, it's a spoiler in terms of international affairs. China, you'd imagine, is sort of the builder. It's here for the long term. It looks at things in the longer term. But Russia's very useful for China, because Russia's almost like sort of an arrow point that it can say things and do things that China, as a sort of more respectable citizen, isn't going to do. But it's very much in China's interest to keep Russia going there, to not allow Russia to end up failing. And Russia, China has benefited a lot there. In Moscow, a lot of people now are driving Chinese cars. China's China's exports to Russia have surged as well there. So it's almost like in time, Russia will just become sort of a strategic appendage in a way, without going overboard. I mean, Russia's always going to be quite nationalistic and independent, but I think Russia's very useful for China now.
And China does need to be strategic, right? We heard against that reiteration of not just the challenges, but still the ambitions to get back to a reasonable level of growth for Beijing. We've got a guest coming up in the next hour that's actually pivoting from US assets to Chinese. Do you think that's a fair argument, not knowing, of course, what policymakers are able to do this year?
Well, I mean, the one thing that has happened over the last couple of years is both that Chinese assets have become more diversified from US assets. That is one place you could go to and say, well, if the AI boom falls over, China stocks could keep motoring along just fine. In particular, if China does succeed in its current efforts to make the economy more about consumption, more about its internal dynamics, if it can resolve the real estate question, and that's precisely because it is facing the threat of tariffs from Trump, and there's also there's a constituency among investors who look at both what went on last time round and see that China actually recovered quite well after the initial shocks, and also what China has done to prepare for the potential of further tariffs, and say that China is actually one of the places around the world that is less vulnerable than many places like other economies, other markets in Asia, to Trump tariffs the second time round.
Catherine Reynolds, who leads our Markets Live Asia coverage, and our economy editor, Michael Heath. They're taking a look at the market risks and opportunities and some of the geopolitical risks going into this year. More ahead on the Asia trade. This is Bloomberg. This is the Asia trade. Well, South Korea's acting president, Choi has rejected a second attempt by his advisors to resign en masse. The group had been seeking to step down since President Yoon Suk-yeol briefly declared martial law last month and was subsequently impeached. This comes after Choi appointed 2 judges to the Constitutional Court, increasing the likelihood of a ruling to finalise Yoon's removal from power. Well, this ongoing, continued political instability in South Korea and the recent Jeju air crash are adding to the downside risks for South Korea's economic growth picture. For more, let's bring our Bloomberg economist, Hyo-sung Hong, who joins us in Seoul. So, talk to us about the sort of meaningful economic impact that we see from the recent and, continued political turmoil affecting South Korea, but of course also the terrible aviation tragedy, the period of mourning that's been put in place as well.
Thanks for having me. The political instability is undermining consumption, consumer and business confidence. Lower confidence means that reduced consumption and delayed investment. In addition, the deep political division and lack of strong leadership are likely to disrupt fiscal policies. For example, the downside fiscal budget will limit the government's ability to stimulate domestic demand this year. Adding to this, South Korea faces external risks from Trump administration's tariff and foreign policies. Political instability will make South Korea difficult to play its best game on this challenge. And in addition, you mentioned the Jeju air crash. It will likely to heavily weigh on consumer sentiment and private consumption. Putting all this together, I expect the economic growth to slow to around 1.5% this year, down from 2.1% last year. A bigger concern is definitely the political instability, if prolonged, could create a more challenging environment for South Korea's long-term growth and external stability.
When we've taken a look at some of the safety events, safety disasters in Korea in the past, from the Sewol ferry tragedy to what happened with the Halloween crowd crush in Seoul, when you take a look at what's now happened with the Jeju air disaster, does it suggest that we are likely again to see that sort of prolonged impact when it comes to household confidence and consumer sentiment?
Based on the past major tragedies, consumer sentiment typically takes a month to recover, but the ongoing political instability could prolong, the economic impact this time. But having said that, this event could also accelerate the Bank of Korea's next rate cut, and also spur the government to bring forward a supplementary budget earlier this year.
What are some of the challenges for the BOK? The currency would be one of them, right? How easy is it for the Bank of Korea to be able to navigate and balance these sort of different factors?
So the Bank of Korea is a difficult situation. It needs to support growth with mounting downside risks from the political instability and the air crash tragedy, and the Trump administration's trade and foreign policies. But the shortfall in the won complicates things by raising the financial stability risks and inflation risks. So in the very near term, I think the next rate cut will be a 50-50 call between January and February. And moving forward, I still expect more cuts on the horizon, but BOK will tread carefully to avoid putting too much pressure on the won.
We've seen key exports for South Korea maintaining momentum. Is that your expectation going into 2025, both in terms of the slowdown in China, but also the potential impact of trade policy from the US?
Yes, I expect the exports momentum will slow down into 2025. So there are two things. First of all, the base effects are more challenging. So last year we saw rapid expansion in exports, and in addition to that, this year we see more challenges from the U.S. trade policies, and also that the Chinese economy is also is likely to slow down this year. So all this together implies that South Korea's exports is likely to slow down this year.
Bloomberg economist Hyosung Kwon there in Seoul. We do have more ahead on the Asia trade. This is Bloomberg. Take a look at how we're faring when it comes to just about half an hour into the start of trading here in Australia, the first trading session of the new year. And wasn't a great sort of end to 2024. The stock benchmark really the biggest knockout out of Asia Pacific peers this month, in December that is, really weighed down by RBA uncertainty, the timeline for rate cuts and China's recovery prospects as well. We are seeing the Aussie dollar moving a little bit higher there. We did have housing prices to note dropping for the first time in 22 months. This is Bloomberg. Take a look at how we're faring when it comes to US futures, looking a little bit more positive after really what was a little bit of a whimper to what was otherwise, of course, a pretty momentous year for US risk assets, right? We're seeing S&P futures as well as NASDAQ 100 futures picking up a little bit, about 0.4% when it comes to the tech-oriented stocks that really lagged going into the end of 2024. We're seeing a little bit of a catch-up there when it comes to Dow Jones futures. Their Asian stocks at the moment primed to start off on a pretty muted note as well after an inauspicious end to what was a pretty stellar 2024 for global equity investors. Let's get some more perspective when it comes to macro momentum for 2025. Of course, we've been talking about geopolitical tensions looming large ahead of Donald Trump's return to the White House. Joining us now is Alexis, Chief Economist at PwC US. And Alexis, always great to have you with us, particularly to kind of set the scene as we look down towards a brand new year. And it's not just geopolitical tensions, right? It's a lot of domestic fiscal policy, immigration policy, trade policy, the US debt ceiling. How do you look at these risks? And do you think, well, as investors seem to be at the moment, be assuming that what we got in 2024 will continue through to 2025?
Well, thanks so much for having me, Heidi. It's a pleasure to join you as always. And certainly as we look out for this question for investors and executives across the globe, it's can the U.S. as this sort of single engine of growth amidst advanced economies really continue this momentum? And we've certainly seen how markets have responded. And we must remind ourselves that the stock market is not the reality. Even prior to the Trump administration, we would have seen some valuations being quite stretched. We also know the concentration of some of this rally within several equity listings as well. So looking out, I think you could see a little bit of a slip in the momentum with regard to markets. As to the U.S. economy and the performance there, I think, again, prior to the Trump victory, we had a forecast for growth starting to slip slightly in 2025, moderating downwards. The U.S. growing at about 3% per annum is about the top end of where an advanced economy can grow. And so moderating somewhat down to 2.5, between 2.4 and 2.5%. The big question, of course, with this policy uncertainty is if you imagine a sort of a seesaw, is the extent to which some of and a degree of some of the policies that have been announced on the campaign trail might actually be enacted, and in what time. So will an escalation of tariffs actually come through? Will some of the deportations and immigration restrictions actually come through and be implemented? And will those happen before some of the potential tax cuts and deregulation actually take place? And that's certainly what we have our eyes focused on.
There's so much uncertainty, right, when it comes to timing, when it comes to the ability to execute the rhetoric going into the rest of the year. If you take a look at immigration in particular, talk to us about, I guess, the knock-on effects, not just when it comes to, impact on inflation and labour costs, but also perhaps the longer-term concerns on innovation, which is sort of why we're seeing this big debate between big tech, Elon Musk, and President-elect Trump.
Well, thank you. So it's interesting to note because everyone's really focused on the impact of what would potential deportations or any kind of curtailment of immigration numbers in the United States due to labor markets, due to wages, and due to inflation, and therefore the federal funds rate. So as you rightly point out, this is kind of the short to medium term impacts. But I actually have greater concern about some of the structural impacts that can happen with regard to innovation. So a lot of research in the United States indicates that there's a very positive correlation between counties which have a very high number of immigrants coming in and innovation over time. And you can see that with certain MSAs, like looking to San Jose, the San Francisco Bay Area, et cetera, and the immigration that supported innovation in those industries over decades. Now, a lot of that actually is skewed toward the higher educated migrants as well. So as we move forward, there is a great concern that you won't necessarily see the type of innovation over the longer term should any meaningful curtailment on immigration actually happen. So that's certainly where I would be more focused on, is looking beyond 2025 and some of the larger structural drag.
We ended the year with a bit of a tussle over the debt ceiling, and that's set to continue. But it's also not just the US when it comes to the fiscal picture, right? Do you expect, some of these sort of fiscal houses to be put back into order this year, or is that going to be an ongoing risk for investors?
Well, it's interesting, Heidi. The word that came to mind when I was thinking about it is the German word Teufelskreis, which is just sort of a devil's circle that kind of goes back and forth. Because what we've certainly seen since 2016 is sharp rising polarization within domestic societies. And then we've seen policymakers resort to using fiscal tools to be able to quell some of the fire in the storm. So again, that was even prior to the experience of the pandemic. Then we all ran through fiscal spigots throughout the pandemic. Then we had Russia's invasion of Ukraine, all of this leading to record high levels of government debt for G7 economies. We also just have other factors that contribute to an elevated cost of living crisis beyond some of these geopolitical tensions, such as Russia's invasion of Ukraine. One of these is the housing market. Shelter costs remain deeply unaffordable for large parts of the population across advanced and emerging market economies alike. Shelter represented 40% of the increase in the latest CPI data that we have in the United States. So the extent to which actually policymakers can constructively use fiscal tools to be able to create more supply in housing is one that's going to come into focus. That's something that on the campaign trail that both Kamala Harris and President Trump had put forward. And so we'll see the extent to which some of those policies can actually take place. Of course, a country sitting in your part of the world, in Singapore, is another great example of a country that's done that positively. But I think what we'll see for 2025 is really this day of reckoning, where, of course, market participants are going to be very carefully judging the extent to which countries will actually make good on their debt. And the U.S. is not immune to that.
Policy execution and effectiveness is obviously key for Beijing as well, right? What are your expectations for China, particularly as, of course, at the same time, they're dealing with domestic struggles? There's also the external risk from Trump 2.0 as well.
Well, you raise an interesting point, Heidi, which is, there's this great French expression, which is plus ça change, like nothing has really changed that much. And if we actually look at trade restrictions on trade in goods, trade in services, and trade in investment flows, we've seen rising trade restrictions since 2019. So really, we're in an environment in which we have record number of trade restrictions. So some countries, companies, and actually investors have figured out how to navigate this. And China, I think, is probably quite a strong example of a country that's managed to navigate some of these trade wins quite effectively. So if we just look at the BEV market, for example, even though we're seeing a lot of trade restrictions between the EU and Beijing with regard to BEVs and that entire outlook, see strong export markets from China to Brazil, to Thailand, to the Philippines, and China is really leading in the space. We've seen industrial production numbers come up significantly, exceeding forecasts over the last few months of the year. So China has been able to pivot in a fantastic way. What I worry about a little bit is just the impact on the consumer. We've seen consumer sentiment starting to drag, this expression, tang ping, of just laying flat, and the consumer just laying flat amidst a lot of the changes that China has witnessed since 2021 onwards. That's where I'm a little bit concerned as to the durability of the Chinese consumer amidst some of these, a weakening external outlook as well.
It's quite interesting. We were talking a little bit earlier about what the potential sort of geopolitical landscape when it comes to the Middle East, when it comes to Russia, Ukraine might look like. Has it surprised you that investors and markets have sort of broadly been very sanguine to this nature of conflicts? Is that something that is just sort of the nature of what happens when global stocks are broadly rallying?
Honestly, Heidi, I think it's just our addiction to monetary policy. It is really the FOMC minutes that move markets. It's not geopolitics, and that's been the case. So what I would counsel, and what I do counsel to investors and executives, is use geopolitics as a dislocation moment. There's an entry moment when some confidence floods out of markets, and we've seen that with the sharp rise in the VIX, in certain events, in certain world events. But where we stand today, it's interesting. I think we have two live wars, right? One of which, of course, continues to weigh on the economic outlook in Europe. There's no avoiding that. The other one, what's interesting is, even despite the human tragedy that's unfolding within the live conflict in the Middle East, there are certain economies there, such as the UAE and Saudi Arabia, which are poised to grow significantly. The UAE forecasted to be one of the fastest growing economies by the IMF for 2025. And so that, I think, is also important to note, is that even despite some of these conflicts, you can actually still have strong economic growth. The question becomes, to what extent will geopolitics continue to pop up in the world's largest advanced economy? And that's certainly what we're all focused on for January onwards.
Alexis, always great to chat with you. Alexis Crowe, Chief Economist at PwC US. Some of the other stories that we're following this hour, and President-elect Donald Trump says he will lobby House Republicans if necessary to help elect Mike Johnson as Speaker. Trump endorsed Johnson on Monday ahead of a House vote on Friday. Johnson faces criticism within the party after backing a temporary spending deal that left out some Trump demands. Taiwanese President Lai Ching-te says that he'll keep boosting defence spending as Beijing intensifies drills around the island. In his New Year address, Lai said that Taiwan needs to be prepared for danger in times of peace. Taiwan's commitment to record military spending this year faces resistance from opposition parties trying to revamp the budget. Bloomberg has learnt that China has given civil servants their first significant pay rise in years as policymakers try to boost morale and spur spending. Sources tell us the basic salaries of many government employees have been bolstered by some $68 a month, backdated to July. The pay rise goes to teachers, police officers and bureaucrats. Indonesia has scaled back its planned increase in the value-added tax rate amid escalating public pressure. President Prabowo Subianto said only luxury goods will be subjected to a 12% VAT rate. All other goods and services will be subjected to the current VAT rate of 11%. The government has also decided to maintain the VAT exemption for basic necessities and will still provide social aid for poor households. More ahead on the Asia trade. This is Bloomberg. Some other corporate stories we're following this morning. Alibaba is selling its shares in Sun Art to private equity firm DCP Capital. The Chinese e-commerce giant could receive up to $1.6 billion from the sale, which is less than the $3.6 billion it paid in 2020. The sale accelerates Alibaba's retreat from physical retail as it focuses on investment on areas that it considers more promising, such as cloud and online marketplaces. Chinese EV giant BYD hit a new monthly sales record in December, spurred on by subsidies and offers of extra incentives to buyers. The company says it sold over 500,000 vehicles last month, pushing total sales of 4.25 million passenger cars in 2024 and narrowing its gap with Tesla. Meanwhile, Elon Musk's car company is due to report production and delivery figures later on Thursday. Analysts think Tesla may post its first annual sales decline in over a decade, despite optimism around Musk's relationship with the president-elect Donald Trump. Well, the second season of Netflix's survival series, Squid Game, has attracted nearly 70 million views since its debut last week. Netflix says it's the most-watched TV show in 92 countries. Bloomberg's Soo-hee Kim joins us now from Seoul. So, Soo-hee, tell us more about how Squid Game Season 2 has performed so far. And it's been a mixed reaction, but certainly the numbers would make it a huge success.
Netflix global sensation Squid Game Season 2 returned with a good blast. And it's been like smashing records at attracting more than 68 million views since its December 26th premiere. The show has topped Netflix charts worldwide, becoming the most watched program in 92 countries. So this makes it the biggest debut ever for a Netflix original series. But as you mentioned, despite this record-breaking viewership, the new season has been met with a somewhat divided response initially. Critics and fans, they've been pointing out that the pacing feels a little bit slower and some of the plot elements seem repetitive compared to the first season, but I personally liked it. But it is too early to conclude whether it's a success series or not, since this kind of blockbuster often takes few weeks to get full reactions that sometimes turn into social phenomena.
I have to say I'm only about 3 episodes in, but, enjoying it so far. But what's really at stake here for Netflix in terms of its investment and how it plans programming to come?
The stakes are high for Netflix as it's trying to keep the Squid Game franchise afloat globally. After generating about $900 million in value for Netflix after its first release, they've been expanding the theme with reality TV shows, video games, and in-person fan experiences worldwide. So their marketing for the second season was the biggest scale for any TV series franchise. While it's awaiting for the final and third season later this year, Netflix is expected to push for award campaigns at Golden Globes and Oscar that might be helpful to continue the momentum till the final season. So all of these efforts are important for Netflix to continue to lead the streaming market that no other platforms can offer. And with its scale and capabilities, it may continue to expand the franchise with English language adaptations or a couple of spin-offs.
Bloomberg Soo Kim there in Seoul. Let's get you a quick look at these markets, and it is a pretty slow start to the new year. We do have Australia trading, but of course in New Zealand, as well as some of these other markets, including Japan, we are still seeing market closures for the New Year holiday. We are also seeing a late start to trading when it comes to South Korea later on today as well. It is looking like a pretty slow start when it comes to just a bit of a whimper of an end to 2024, despite, of course, an otherwise stellar year for global equity investors. We had that pullback from US stock indices, the S&P 500 and the Nasdaq 100, both dropping for a fourth consecutive session in that year-end pullback. So more than $1 trillion being shaved from large cap market values, and we're seeing that sort of carry through here, particularly as we saw futures for Shanghai as well as mainland Chinese gauges tumbling in the last day of trading there as well. We're watching dollar yen at the moment. 157.47 is where we're at. Remember, Goldman Sachs saying that this kind of sweet spot when it comes to dollar yen is good for global investors into Japanese equities. We're also watching dollar yuan, given just the really resilience of that dollar dominance theme all throughout 2024 and the pressure that we have seen when it comes to the Chinese currency. We did hear from that Chinese, the New Year speech, I should say, from President Xi Jinping, saying that 2024 GDP growth is set to hit that target of around 5%, so on track to meet the official economic goal there. More ahead on the Asia trade, this is Bloomberg. Nippon Steel has offered to give the US government a veto over any reduction in US Steel's production capacity in a last-ditch effort to win approval for its takeover. Shares of US Steel surged after that report, although President Biden is still expected to block the deal. Let's get more from Bloomberg's Clara Ferreira-Marquez there. Clara, so does this sort of move the needle or change the calculus at all in terms of the opposition?
It's an interesting move because we're really getting close to the point at which President Biden will have to make a decision. That comes next week. So roughly 2 weeks since CFIUS came to obviously no conclusion, left it with Biden. So what Nippon Steel is doing here is really coming in with a last-ditch offer, offering to maintain production capacity, or at least to give the US government an effective veto on significant production capacity. It looks unlikely to change President Biden's mind, but we still have a week to go, so a lot could yet happen.
Is there a possibility that these negotiations could push this past Inauguration Day and we have a situation where the sort of final decision is actually down to a Trump administration?
That's a very interesting possibility at this point. So really what Nippon Steel has done here is reopen negotiations in terms of additional conditions that the US government could demand. So it's possible that the Biden administration could look to a yes with conditions around, for example, production capacity or investment. And remember, Nippon Steel has already made a number of these concessions in terms of board, in terms of keeping the company based where it is. But yes, the Biden administration could demand more. At that point, it is very likely that this would go past not only the January 7th, but potentially January 20th date as they hammer out these conditions. Leaving it with the Trump administration, it is, it's difficult to see how this gets passed. Trump has been extremely clear, President-elect Donald Trump has been extremely clear on how he sees the deal, and it's hard to see Nippon Steel coming out with what it wants. Having said that, transactional administration, it's still open.
Yes, we do know that, President-elect Trump does enjoy the ability to make a deal. But if we do assume that this kind of ends up in a dead end again, what are the implications for these parties?
Well, for US Steel, this does raise the question of who will put these billions in, because remember, even just keeping the production capacity, which is what Nippon Steel is offering in its latest concession, would require billions of investment into these mills. So who would be doing that if it isn't Nippon Steel? For Nippon Steel, there is the question of growth. If it isn't the US market, where will it look to compensate for a Japanese market that isn't quite expanding at the levels that it requires. It could potentially look elsewhere in Asia, for example. It could look to India. So that becomes a very interesting question for Nippon Steel. I mean, once you make an offer of this magnitude, you have really signaled to the market that you require additional growth from somewhere. So all of that remains to be resolved into the new year. At the moment, however, the deal is not exactly alive, but still there. Not exactly kicking, but still alive, let's say. So let's see over the next week. We have until January 7th.
Bloomberg's Clara Ferrer-Marquez from Singapore with the latest on Nippon Steel and US Steel. But take a look at what we're watching when it comes to cryptocurrencies and Bitcoin. And of course, what a huge year, what a huge sort of final quarter it was for crypto prices, and a lot of uncertainties, but of course, a lot of expectation for outperformance going into 2025 and the favorable nature of crypto policies expected from the Trump administration, and of course, the impact of Elon Musk there as well. We are seeing, though, that downside continue into the start of the year. At this point, Bitcoin off by just about 0.4%. We have seen that slippage as investors have been cashing in on what has truly been that record rally. For December, we saw that first monthly drop since August for Bitcoin, down over 3%. We have really kind of US investors pulling profits and reducing those expectations when it comes to the rate and pace of easing from the Fed as well. Still, though, despite sort of the most recent pullback, Bitcoin still putting on 120% in 2024. It clearly outperforms gold, it clearly outperforms global equities there as well. We're seeing sort of that similar downside across some of those other crypto assets as well. Ether, Solana and Dogecoin down by just about 0.5% as well. So we have seen sort of that net outflow when it comes to Bitcoin ETF funds in the US, about $1.8 billion pulled out since December 19th. Take a look at what we're watching when it comes to some of the stocks and assets that are trading at the moment. Of course, holidays still for New Zealand, as well as trading in Japan being closed as well. South Korea getting off to a later start. We are seeing a little bit of upside there for Aussie stocks, perhaps a little bit of a refresh after we saw the December period, seeing Australian stocks capping the month as Asia's worst performer, down about 3% in the last month of the year. This is Bloomberg. We are an hour into the start of trading in Australia. We are seeing a little bit of tepid upside there. We did see really kind of a pretty inauspicious end to 2024, despite what has been a stellar year for global equity investors more broadly, particularly if you've been invested in the US. But there was some sort of profit taking and illiquidity at play going into the end of the year. We're seeing a bit of upside there, although we are off our session highs, really trying to come back when it comes to Australian stocks, which were Asia's worst performer in the month of December, having lost about 3% in that month. We are seeing the Aussie dollar holding at about 61.93. A lot of these uncertainties over when the RBA will join the global rate cutting cycle, as well as some of these concerns over China as well, which could lead to more opportunity, particularly when it comes to potential gains for mining and some of the more China-related stocks trading here in Australia. We do hear some breaking news as well when it comes to Singapore GDP numbers just crossing the Bloomberg now. We're seeing fourth quarter numbers there for year on year coming through at 4.3%. That is a beat on expectations. We're also seeing that annual number of 4% was higher than expectations of 3.7% as well. Let's get some more now from Haslinda Amin, who's our Bloomberg Insight anchor, who joins us now from Singapore. And we did hear about that sort of 4% when it comes to an annual basis already. So things are looking pretty good.
Looking pretty good, and good news to start off 2025, Heidi. We heard from Prime Minister Lawrence Wong just overnight in his New Year's message talking about that 4% growth. And he put it in the context of a very challenging external environment. We're talking about continued war in Ukraine, tensions in the Middle East. And he talked about how, you know, when you take a look at the world, there's a deep sense of angst and anxiety for the future, and that angst and anxiety is what people are expecting in 2025. It is exactly what Singapore itself is concerned about. Remember, trade is 3 times GDP. It is an open economy. It is a trading economy. And we've heard how Trump is talking about perhaps 60% tariffs on Chinese products, 20% tariffs for the rest of the world. If those tariffs are implemented, Haidi, it would mean slower growth. And for a nation, a trading nation, an open nation like Singapore, that means its growth may be impacted. So we heard from Prime Minister Wong about how he hopes to help Singapore navigate those challenges. Remember, Singapore, he says, has good, strong relations with the U.S. It's managed that relationship before. It's adopted a neutral policy, neutral stance when it comes to its relations with China, with the U.S., even though the two sides have been bickering for years now. So let's see how it goes for 2025. But suffice to say, it will be a challenging environment for the Lion City.
Our Insight anchor has Linda Armin there. Let's get you straight to President Biden, who's making some remarks at the moment, of course, in the aftermath of the pickup truck that ploughed through the crowd in New Orleans, killing, according to the FBI, at least 15 people. Take a listen.
Like any other place in the world. It's a city full of charm and joy. So many people around the world love New Orleans because of its history, its culture, and above all, its people. So I know, while this person committed a terrible assault on the city, the spirit of our New Orleans will never, never, never be defeated. It always will shine forth. We've seen that time and time again throughout its history, and I know we'll see it again in the days and weeks ahead. May God bless the people of New Orleans. May God bless our police and our first responders. May God protect our troops, and we'll keep you fully, contemporaneously informed. Thank you.
Have you spoken to President Trump? Will you visit
President Biden there making some short remarks, just responding to a couple of incidents that we've seen, of course, including the truck that ploughed through the New Orleans crowd. According to the FBI, now at least 15 people dead in the French Quarter and more than 30 injured. And investigations are underway for accomplices in that incident as well. Also mentioning that they're tracking the explosion of the Cybertruck outside the Trump Hotel in Las Vegas as well, which Elon Musk has also weighed in, saying that it was either explosives or fireworks behind that explosion. We'll continue to bring you the latest on those incidents and developments as they get to us. Our next guest sees Chinese markets outperforming the US in a relative sense in 2025. Let's bring Richard Harris, CEO at Port Shelter Investment Management, joining us from Hong Kong. Richard, great to have you with us. And, you know, despite the landscape of risks, geopolitical, Fed-related and others this year, there's plenty of people that are in the camp that see further gains when it comes to this US-led US exceptionalism rally, right? Do you think there is reason for you to switch course?
Well, I think when you say US exceptionalism, all markets are exceptional sometimes, but exceptionalism obviously is very much a temporary thing. I mean, I'm looking at 2025 being the year of the great pivot. And by that I mean I think China is likely to outperform the US. If you have a pivot, you have weights on both sides. On the US side, we have Trump coming in, which I think is bringing a lot of uncertainty into the US market. I think that the policies of immigration and of tariffs are very inflationary. The policy of cutting taxes is very much what is trusted in the UK, and look what that did to the bond market. So I don't think Trump's policies are likely to be particularly good for the US. Well, on the other side, we've got China, who now has put perhaps $2 trillion into a $19 trillion economy, and that's over the last 15 months. And I know a lot of observers have said it's not enough, but I think what they're forgetting actually is that this has now been happening for about 15 months or so. So we're likely to see China be influenced by much more stimulus, the kind of stimulus that we previously saw in the West, while the US comes back. And I think that that's likely to pivot the market and interest in stock markets towards China.
It's interesting. A lot of people are excited about, the sort of was seen as being a disruptive force from Trump 2.0, and of course some of his advisors and cabinet members, including the likes of Elon Musk. But tell us about what you call the Humpty Dumpty paradox and how that sort of plays into your policy and efficacy expectations for US government.
Well, I think one of the problems is that if you try and change government dramatically. You see what Elon Musk did with Twitter. He came in, he fired loads of people. He then realized a lot of those people he really needed, but he still didn't bring them back together again. It's not actually particularly difficult to break something and to clear out vast amounts of bureaucracy, which undoubtedly is there. It's much more difficult to put it back together again, and this is why I call it the Humpty Dumpty paradox. It's easy for people to go in, change something, break it, much harder to fix it, and very often when it's time to fix it, those same people aren't on the scene anymore. And then you've lost a lot of institutional memory from within those organizations. So I'm all in favor of cutting bureaucracy, and there's far, far too much in all Western governments with people checking on people. But I think it has to be done systematically and not in a way that you just break and hope that it'll all be put back together again by magic.
So how do you, I guess, look for opportunities of diversification from the trade that has been so stellar for 2024? We can talk a little bit more about China and the expectations, but a lot of that hinges on what the government can actually achieve with fiscal stimulus.
Well, that's right. But I think, we're talking about China, so the government can achieve what it wants. And I think their general policy has shown that they will do what it takes. China has been very weak for around 3 years now. The consumer obviously has a real crisis of confidence, and the Chinese authorities, I think, will bit by bit start building that confidence up through fiscal measures, through money going into the economy, through grassroots development. All this is yet to come, and I think they're probably holding on to see exactly what Trump will do. But I think there's more stimulus to come in China. So I think China is likely to see the kind of liquidity rally that we've seen in the US and Europe. Remember that economies basically are the same around the world. If you have a liquidity rally, that's going to end up in the stock market. And I think that's what's going to happen in China as well.
There is an element that the structural slowdown in China, one is, perhaps healthily part of a new normal, and the other is the worry that confidence-wise, the sort of deflationary spiral-wise, that it might take a little bit more, or it might be very challenging even for fiscal stimulus to be able to lift that now.
Well, yeah, I mean, in a sense, we're in the part of the J-curve that's still going down at the moment. We've had the stimulus go in. China's a very big economy. It's the oil tanker. It takes a long time to turn around. We're starting to see some green shoots in some of the indicators, and especially in Hong Kong, where we've seen both primary and secondary real estate markets firm up a little bit. But I think that you're quite right at the beginning. What you said there is that China actually is going through a phase now where it really is a developed economy. If you go to China, especially to the key first-level cities, they are very sophisticated and on a par with anywhere else in the world. If you look at many areas in Europe and the US, they're almost at a post-developed market status where there's no money for a lot of investment, where there's high debt, where there's high demand, very little way that they can actually cut budgets. So we're almost in a stage where China needs to be considered to be a developed market. As a developed market, it's likely to grow like a developed market, so I suspect we're going to see growth rates of 3% becoming the new norm in China, rather than the 5% that we see at the moment.
Richard Harris, CEO at Port Shelter Investment Management. Richard, staying with us. Lots more to talk about, of course, as we look ahead to the new year. More ahead to here on the Asia Trade. This is Bloomberg. We are getting that late start to trading in South Korea today, as of course a number of other markets remain closed for the holidays, including in Japan and over in New Zealand as well. We're just about 47 minutes away from the start of trading in South Korea. This is, of course, we continue to see really further pressure on the South Korean economy and further complications for the Bank of Korea as well. One of those pressures coming from the ongoing political turmoil, with South Korea's acting president, Choi rejecting a second attempt by his own advisors to resign en masse. The group had been seeking to step down since President Yoon Suk-yeol briefly declared martial law last month and was subsequently impeached. Bloomberg's Yu-Kyung Lee is in Seoul with the latest. And Yu-Kyung, this is sort of another attempt by this group of aides and advisors to step down. What are we hearing?
Yes, that's right, Heidi. So it's the new year, but it seems like there's no end in the political turmoil in South Korea. So this is not the first time that the presidential aides has been trying to resign in droves. But this attempt comes after the acting president Choi Sang-mo appointed 2 justices to the Constitutional Court, bringing the number of judges at the Constitutional Court to 8, which raises the likelihood of a ruling that would finalize Yoon's removal from the power. So the resignation attempt by the presidential office secretary of chief secretary and the director of national policy and other presidential aides drew immediate criticism from the opposition party that they were trying to the move was in protest of Choi's move to appoint new judges to the Constitutional Court, and hence opposition party criticized the move as trying to defend Yoon's martial law declaration that on December 3rd, which is now under criminal investigation. So this is not the first time that these aides have been trying to step down, but the bid was immediately rejected by the acting president Choi, who said we need to focus on stabilizing the state matters.
And of course, at the end of the year, we saw the arrest warrant being issued for Yoon. What do we expect in terms of further developments in this process?
That's right. So in an unprecedented move, we saw this arrest warrant on the impeached leader Yoon has been issued by the court. But the investigators may face challenges actually trying to arrest Yoon because his secretary and his legal representative has been saying that the arrest warrant is invalid and it's not legal. They're trying to stop the investigator from trying to arrest Yoon. Now, Yoon is under criminal investigation for the insurrection charges, but there's been a lot of challenges as even though Yoon has said he would fight till the end and he would collaborate with the investigation, he actually has been has not. Some people say he actually has not been collaborating. So it looks like there will still be a lot of challenges ahead for the investigators who are investigating the criminal probe against Yoon on the insurrection charges.
Bloomberg's Yu-Kyung Lee there from Seoul. And of course, we continue to watch South Korea in terms of the investigation that's ongoing into the devastating Jeju air crash that killed 179 people. Some headway is being made when it comes to the recovery and extraction of data from the cockpit recorder. We're hearing now from the acting president Choi saying in a meeting regarding the plane crash that they'll be converting that cockpit voice recorder data into files by Friday, which hopefully will give investigators a little bit more details into what caused the crash of the Boeing 737-800 aircraft. Of course, there's been, information regarding a bird strike, but also a lot of mystery and speculation as to what might have happened, including, of course, the failure to be able to use the landing gear as well. So this data, which we're being told now we should expect by Friday to be converted into a file, it could offer more clues into how that plane crashed. But the flight data recorder did lose a crucial cable. Investigators have been working to restore that data. Well, let's bring back Richard Harris, who's a CEO at Port Shelter Investment Management. Richard, great to have you with us. When you take a look at some of these Asian markets, and of course with sort of idiosyncratic growth stories, we've been talking a little bit about just the really myriad challenges facing South Korea, for example. Japan had, all in all, a pretty great year in terms of how investors sort of benefited from the pivot from the BOJ. Where do you see the opportunities outside of China?
Well, I think certainly if we're looking at Asia, it's difficult. Asia had a difficult year last year, and it seems to be the kind of trend that's likely to continue at the moment. Certainly if we see markets continue as they are, I think that Asia might continue to have a fairly difficult year. You know, we've had political issues, as we said, in Korea. Japan, the market did very well, but then the currency did very badly. So if you're an international investor, you haven't done quite as well as you would have hoped. And other markets have been quite weak as well. So I don't really see an awful lot happening there. I think the underlying economies will continue to move along. Now, obviously, if the Chinese economy picks up, that will help, certainly, some of the export markets of some of these Asian countries. But at the moment, I think that we need to have something clear like that. A Chinese pickup is going to take months anyway before we actually need to have a lot of optimism, I think, in Southeast Asia at the moment.
It's interesting the lack of impact that we've seen from sort of broader geopolitical and really straight out conflicts, right? But you talk about the Middle East or Ukraine. So much of this has been put down to just a heavy focus on monetary policy. Do you expect that sort of sanguineness to these sorts of events and conflicts to continue this year?
Well, I think one of the big stories over the last 2 to 3 years is how come we've had 2 major wars and a significant rise in interest rates, and the markets have continued to go up. And that's not only up in the US, but, you know, we've had reasonable rises in Europe, pretty well 20% over 2 years, and the last 2 years has been quite kind. We have had different factors. For instance, 2023, I guess, was the year when liquidity was still coming through from the whole release of liquidity during COVID. 2024, we expected would be not a particularly positive year, but then the consumer came through when we didn't expect. We had the AI bubble that came through, which we didn't expect. It seems a little bit more difficult to see what's going to come through this year. We've had such a run of good news for the markets, and they've resisted the bad news so much that it seems to be difficult to see how that circle of good occurrences is likely to continue. You know, it's been a perfect situation in many ways. So I think 2025 at the moment doesn't look particularly good. We've got a new president coming in with some very uncertain policies. We still have wars continuing, and clearly if there's a ceasefire in Ukraine, well, that may well give Putin more time to make mischief elsewhere. Bright spot at the moment is Syria, but that's yet to be seen exactly how that's going to turn out. But at the moment, I think that we're looking at perhaps quite a difficult year, with the only real bright spot being that interest rates may still start trending downwards, continue to trend downwards.
Richard, you mentioned the AI bubble, and I wonder, do you think this is a year that we see, you know, not just calls for more meaningful investment into AI, but perhaps a loss of patience by Wall Street?
Well, I think that's a very good point. You know, we've had a lot of investment go in. We've gone up the curve significantly in terms of what AI can do. We also know quite a lot now about what AI can't do, and some of the key issues of verification that need to go in. So I think we're probably going to go into more consolidation phase like that. But I think despite my relative bearishness on markets, I mean, I'm looking maybe at a negative 10% kind of year, I think the tech is still the place to be. You know, it's the darling sector of our age. It's the thing that is going to provide economies for corporates where economies are needed if we do go into a more difficult phase. So I think if the tech sector is still going to be an important sector. But of course, if markets come off, they're going to come off as well.
Crypto, do you want to wade in there at all?
Well, after 2024, I think I'd be pretty cautious. Crypto, of course, is a narrative. It's not really backed by anything significant or substantial. Yes, we've got blockchain, which has come out of it, which has been very good. We've got the idea of digital currencies coming out of it, which is very good. But digital currencies will fundamentally be a digital form of what we have now. So Bitcoin is really going to depend on the narrative and where the narrative goes. It's had a big run with Trump backing it and with Musk backing it, but whether it's going to have the same impetus in the narrative in 2025, I somewhat doubt. It may well still go up, but I think we'll see very moderate increases.
You know, black swans by their nature can't be predicted, right? But what would you be sort of looking out for in terms of maybe grey swans or risks that we haven't been talking enough about?
Yes, these are the unknown unknowns. I mean, if we do have a massive trigger that says trigger the markets, and if you have a trigger, it's likely to trigger it downwards because markets are very high at the moment, it's going to be something that will cause some kind of liquidity crisis. My feeling is that 2025, we're not going to see that. The reason being, at the moment, bull markets die hard. We've had a very, very long bull market. There's still optimism there. There's still liquidity there. There's still companies doing some unusual things. So I don't think 2025 is going to be the year of the big crash. But, you know, who knows whether one of these unknown events might come along and change the narrative.
Richard Harris, CEO at Port Shelton Investment Management. Always great to chat with you. We do have more ahead on the Asia Trade. This is Bloomberg. This is the Asia Trade. Some of the stories that we're following from around the world this hour. The FBI says it's investigating a terrorist attack and hunting possible accomplices after a truck was deliberately driven into a crowd in New Orleans, killing at least 15 people. The suspect's been named as Shamshad Din Jabbar, who's a US citizen from Texas. He was killed in a shootout with police in which 2 officers were shot. The FBI says an ISIS flag was found and they don't believe that the killer acted alone. Meanwhile, Elon Musk says the explosion of a Tesla Cybertruck outside the Trump Las Vegas hotel was probably an act of terrorism. The driver was killed and 7 people suffered minor injuries. In a series of posts on X, the Tesla CEO said the explosion was caused by fireworks or a bomb carried in the rented Cybertruck and was not related to the vehicle itself. President Biden says officials are investigating whether there is any possible connection with the attack in New Orleans.
We're tracking the explosion of a Cybertruck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection with the attack in New Orleans. Thus far, there's nothing to report on that score at this time.
President-elect Donald Trump says he will lobby House Republicans if necessary to help elect Mike Johnson as Speaker. Trump endorsed Johnson on Monday ahead of a House vote on Friday. Johnson faces criticism within a party after backing a temporary spending deal that left out some Trump demands. Take a look at how European stocks and futures are opening up for this kicking off of the new year. We are seeing broad downside there. So we see Euro Stoxx 50 futures off by about 0.25%, a little bit steeper when it comes to losses for German stock futures there at the moment. In terms of the standouts, so potentially we could see that sort of end to the rally that we've seen across French equities in 2024, I should say. Of course, a lot of political risk weighing across many of these European markets. Take a look at how we're kicking off the year when it comes to trading across energy assets and commodities in particular. Oil, of course, which has been just range bound for the past few months there, looking like we are seeing a little bit of a move to the upside, steadying moves, I should say. In that first session of the new year, we did see an industry report indicating shrinking US crude stockpiles there. So we have been in that range since about mid-October, with WTI ending the year pretty much little changed. Brent posting a bit of a modest decline there. We are also watching, of course, some of the geopolitical implications across the region as we potentially brace for some more of the uncertainty when it comes to that front, with foreign policy from the incoming Trump administration in focus as to how that potentially impacts, of course, that Ukraine and Russia war. We have seen that gas supply from Russia to Europe halted after the Ukraine transit deal saw the expiration. So what we're watching at the moment is really that flow of natural gas from Russia to Europe being suspended on New Year's Day after Ukraine said that it would not renew that deal, allowing Russian gas to transit its territory. This puts an end to an energy supply route that has dated back to some 60 years, so really kind of creating a little bit more uncertainty for that part of the market. So despite, of course, that ongoing conflict and the Russian invasion, we have seen Ukraine allowing that Russian oil access and Russian gas access as well. Let's bring in for some more details on Bloomberg senior energy reporter Stephen Stupczynski joining us now. Stephen, great to have you with us. Talk to us about sort of some of the broader implications of these latest developments.
Yeah, I mean, now that Europe has lost this Russian supply route, that takes about 5% of their supply now out of the market. So now they depend on Russian supply, just 5% at the moment. So it went from 10% with this pipeline, now it's down to 5%. Before the war in Ukraine began, they depend on Russia for 45% of their total gas. So it is not it's not going to lead to enormous shortages, but it does risk Europe having to rely more on the gas that's in storage. So they're going to deplete that storage more. They're going to have to rely more on different routes for gas. There is another route to get Russian gas into Europe. It's called Turk Stream, but it's not able to make up for the lost supply in Ukraine. So you're only going to partially get some of that potentially through that pipeline. It won't go to all the countries that would also need it. There are Central European countries that relied on the Ukraine pipes. Another route would be liquefied natural gas. You can import that there via ports. It's a seaborne fuel. But again, there as well, that could lead to higher prices. That LNG is more expensive than the Russian gas that was being sent through Ukraine. That's something that Slovakia has said, that finding alternatives would increase the price of their gas by about $90 million a year. So there are alternatives, but ultimately it will lead to likely higher prices, more volatility, and potentially more competition around the world for gas as global supply just sort of tightens because of this.
Does that have a meaningful impact when it comes to gas sales revenue for Russia? And I suppose conversely, does it raise other risks for Ukraine in taking this step?
Yeah, I mean, for Russia, it certainly is one avenue of revenue that they're going to be losing. Bloomberg estimates that's about $6 billion a year that they could be making off of the gas that they send through Ukraine. It was more years ago. A lot of the flow via Ukraine had dropped since about 2015 onward. But still, that's a large chunk of change, and it's money that is very important for Moscow as they continue this war, and as they look at different ways to continue pumping money into the coffers. Now, of course, this also has implication for Ukraine. Ukraine was making about less than $1 billion a year just on transit fees. Now, I do have to note that Ukraine wasn't getting any of the gas from the pipelines. They weren't consuming Russian gas. They were purely just a conduit for Russian gas to get to Europe. But still, transit fees are getting about less than $1 billion a year from that. But in the grand scheme of things, it likely won't have a large enough impact economically on Ukraine to affect how they operate. But I have seen online some commentators have noted that as Ukraine is going into another year of war, they will also need as much money as they can get and increase and have their revenue as stable as they can get. So losing this revenue stream, again, is problematic. It is something that they're going to have to deal with. But clearly, this was a strategic move. They didn't want to continue funding Moscow and Putin's regime. So this is why they decided they were the ones who did not want to extend this agreement that expired just yesterday.
Bloomberg senior energy reporter Stephen Stepczynski there with the latest. Let's get some more analysis when it comes to the implications of this, the outlook broadly for oil and risks for demand across energy assets. Joining us now is Scott Darling, who's a managing director at Haitong International Securities. Scott, great to have you with us. And so I guess we'll start off with kind of this latest development, the cutting off of this supply through to European markets. How meaningful is this for you, and how do you, I guess, sort of view this as whether there's any change to the broader landscape of supply and pricing dynamics?
Yeah, Haitong, look, agree with Stephen. I think this is going to further tighten the LNG market. Haitong have been quite constructive around global energy. We think this year and possibly next year is a particularly tight market. If you had a cold period in Europe, particularly, then that would start depleting storage levels, which are ample at the moment. But we believe that supply, particularly for LNG, is tight, and we see more upside risk to spot LNG prices this year and next.
What do you see, particularly when it comes to, you referenced a sort of recent visit to the Middle East, and what was some of the sort of intelligence that was gleaned from that access?
Yeah, so Haitong, we did a big tour in the Middle East recently. A few takeaway points we got is, firstly, demand is particularly strong around energy, whether it's natural gas or oil or fuel products. Also, there is a growing and accelerating energy bond between China and the Middle East, particularly in renewables. So the Middle East market is perhaps, their demand is growing by at least 20% each year this decade. China has got the assets like solar and wind assets to actually supply that demand. So increasingly, you're starting to see more cooperation between China and the Middle East, particularly in renewables.
Does that sort of speak to the policy priorities that we see out of Beijing, and is that a trend that Haitong is expecting will continue?
Yes, absolutely. Look, you've got a deflationary environment for renewable assets in China, and you've got demand in the Middle East. And I think increasingly, really since the last 1 or 2 years, you've seen more deals being done, particularly around clean energy. And I think that will be the strategic cooperation between both Middle East governments and also China.
How big a challenge, the geopolitical tensions that are very much expected from a Trump 2.0 administration for China?
Look, on commodities, if you started to see the Russia-Ukraine war end, that would be, we think, particularly bearish for some of the commodities, particularly oil, going forward. I don't think there's too much the new Trump administration can do in terms of incentivizing traditional oil and gas. They can probably give some fiscal benefits, maybe open up a little bit of acreage. But ultimately, energy transition, whether it's in the US or China or Europe, is all about different forms of energy, whichever's attractive to a particular area and particular consumer. So energy transition will be very much more complex and based on really the economics of the energy form in a particular country or area.
For crude, even the numerous geopolitical flashpoints of 2024 sort of failed to produce an ongoing sort of price momentum to the upside, right? Do you kind of see the range-bound, muted trading action and these concerns over a supply glut building and demand continuing to diminish as being the theme that just continues through to 2025?
Yes, we're cautious on Brent this year. We've got a $70 Brent forecast at Haitong. The last, I would say, 2 to 3 years, we've been in a bull market for oil services. So these are the companies which are doing all the drilling. So you can't not then have a supply response to pricing that we saw, the big uplift in oil prices in 2022, and not have some supply consequence. So you're starting to see incremental supply exceed incremental demand this year. So it's not easy to make a case why oil materially goes up.
And so therefore not easy to make a case for sort of any sort of constructive position on oil and energy equities in the region.
Yeah, so we'd be a little bit more cautious. It's difficult to make a case why global or some Asian energy equities outperform other sectors, particularly when you don't really have much earnings momentum. We'd be a little bit more biased, like we were saying before, around LNG producers. We could see some upside. Certainly, we'd be a bit more biased to natural gas companies compared to oil equities.
Are we seeing more countries, start to, or in the process of trying to wean themselves off energy imports as a result of, I guess, this broader thematic of a slowdown or a turning against globalization? And is that a theme that you expect to continue in the years to come?
I think it depends on, each country. I mean, if you look here in China, that, gas imports are, at record levels. I mean, China is the largest importer of natural gas in the world now. It used to be Japan. So I think it depends which country. I definitely think there's a growing trend around, like I mentioned before, energy transition and what form of energy will be acceptable to the consumer in a particular country. I think if there's government support for certain energy forms, that will lead to actually lower imports. But at the moment, certainly this year and next, particularly around natural gas, imports will actually be reasonably robust, whether it's in China, Europe, and some other, certainly other countries in Asia as well.
Scott Darling, who's a managing director at Haitong International Securities. We're taking a look at South Korea, of course, as the economy continues to endure ongoing challenges, both political and from the recent airline disaster. We're hearing now from the Bank of Korea Governor Ri Chang-yong in his New Year's address saying that continued rate cuts could become a source of anxiety. He's vowing to closely monitor risk factors to determine the pace of the monetary policy for the Bank of Korea. Talking about such things as the need to boost stock market via deregulation, as well as new industries, saying they'll decide on the pace of rate cuts flexibly, that the monetary policy aspect needs to be managed with flexibility and nimbly. Continued rate cuts can develop into instability, and it's hard to stabilise an economy with just monetary policy. Regarding the environment in terms of the South Korean economy, Ri's saying that the conditions are to be more difficult and that potentially that creates sort of more challenges. The BOK is scheduled to make its next rate decision this month, but of course, myriad challenges confounding South Korea. Its worst political turmoil in decades, sparked by President Yoon's brief imposition of martial law, which ultimately led to his impeachment, and that continuation of the political turmoil that we continue to watch. Not to mention, of course, we saw that Jeju airplane crash on Sunday that killed all but 181 people on board. A period of mourning being announced for that accident is expected to further dent consumer sentiment. We've seen, of course, the won trading at its lowest level since 2009, and that's really another point of challenge for the Bank of Korea in terms of how and when it can continue to ease. Well, some of the other stories we're following today. Taiwanese President Lai Ching-te says he'll keep boosting defence spending as Beijing intensifies drills around the island. In his New Year address, Lai said that Taiwan needs to be prepared for danger in times of peace. Taiwan's commitment to record military spending this year faces resistance from opposition parties trying to revamp the budget. Bloomberg has learnt that China has given civil servants their first significant pay rise in years as policymakers try to boost morale and spur spending. Sources tell us the basic salaries of many government employees have been bolstered by some $68 a month, backdated to July. The pay rise goes to teachers, police officers and bureaucrats. More ahead on the Asia trade. This is Bloomberg. Watching BYD shares when trading in Hong Kong starts in the next hour, and the Chinese EV giant hitting a new monthly sales record in December, spurred on by subsidies and extra incentives to buyers. For more, let's bring our Bloomberg Asia transport reporter Linda Liu in Hong Kong. So these record sales, what does it kind of tell us about the broader EV market in 2025 in China?
Yes, so BYD's record sales in December really vaulted it towards a new annual sales high as well. Its deliveries this year reached more than 4.2 million passenger cars. The important thing to note that about 1.76 million of those were pure electric vehicles. Now, this means that BYD is consolidating its market leader position even more this year, and that's really actually going to speed up consolidation and pushing some of the smaller players to the brink in China's EV market. We've already seen small companies like Jidu Auto, which is a joint venture between Baidu and Geely, really struggling to continue to operate this year. So heading into 2025, we're going to see even more fierce competition in the Chinese electric vehicle market.
And of course, closing the gap with Tesla, which may not reach its delivery guidance this year. So what does that kind of mean for global EV demand?
Yeah, Tesla's performance is kind of up in the air, with analysts putting out guidance that could mean that Tesla falls short of its annual deliveries by several thousand units for this year. So we're really waiting to see what the final results will be. It's coming out this week. But Tesla's experience actually reflects a wider EV demand slowdown we've seen all across the globe. For European automakers like Volkswagen, Mercedes, BMW, they all kind of struggling to really push EV sales and have to walk back their EV targets for the near future. This happened, after some of the major European Union countries like Germany and France either scaling back or ending their EV subsidies earlier. So, the picture right now for global EV demand is not very clear.
Is it likely that we'll see that competition sort of being superseded by BYD?
Yeah, I think BYD is definitely on a very strong momentum right now. Looking forward to 2025, BYD has signaled, they are going to continue to come out with new model launches at even more affordable pricing. That's going to really ramp up the pressure on its global competitors like Volkswagen and Toyota, as well as Tesla. Now, Tesla still maintains the global electric vehicle champion crown, if it's on track to deliver 1.8 million units for 2024. But, looking ahead to this year, maybe, if Tesla's momentum slows down and BYD's continue to be on a roll, then it could be likely that BYD overtakes Tesla as the global best-selling EV brand.
Bloomberg Asia Transport reporter Linda Lu there in Hong Kong. More ahead on the Asia trade, this is Bloomberg. Take a look at how we're trading. We're just about 2 hours into the session here in Australia, the first trading session of 2025. And we're close to pretty much erasing all of the gains of the session. As of course, we did end out December as the worst performer in the Asia Pacific for Australian stocks, down about 3%. This despite really being a year of record highs for Aussie equities as well, and some expectations that could continue this year, particularly if there is more momentum when it comes to the China recovery story. Well, Alibaba Group has agreed to sell its shares in Sun Art Retail to private equity firm DCP Capital, and loading another high-profile physical commerce asset to focus on its core online business. Our China correspondent Min Min Lo joins us now from Hong Kong. So what do we know about the deal?
Yeah, Alibaba has said that it will receive about $1.6 billion for selling its more than 70% stake in Sun Art. Sun Art is a firm that runs hundreds of hypermarkets across China. It also has a logistics distribution network that really complements Alibaba's own fresh produce supermarkets. But this is actually a loss-making deal for Alibaba because it's receiving about $1.6 billion, but it paid about $3.6 billion just to double its stake in Sun Art back in 2020. And we know that Alibaba has been very dominant in the commerce field, but it has been facing increasing competition from the likes of PDD, for example, and TikTok. So it's been retreating a little bit and focusing more on its core businesses like cloud computing and e-commerce. And this follows another loss-making deal the previous month where Alibaba sold its in-time department store to Yango Fashion for $1 billion, incurring a loss of about $1.3 billion on its initial investment.
Does this sort of fit in when it comes to the broader business strategy?
Yes, Alibaba has put out a statement saying that monetizing its non-core assets would allow it to invest further in its core businesses and also improve shareholders' value, so that $1.6 billion proceeds could be used to invest further or perhaps to carry out share buyback to increase its stock prices, for example. And this comes as we know Alibaba has been trying to expand overseas faster as well. It recently just announced a 50-50 joint venture with South Korean e-commerce firm Emart. And so we know that Alibaba has been trying to ramp up its overseas footprint and also further consolidate and integrate its international and domestic e-commerce business.
Bloomberg's China correspondent Min Min Lo there as look ahead to the start of trading in first session for 2025 when it comes to some of these greater China markets as well. And of course, it was in a lot of respects a very reasonable year when it comes to China equity assets. And we saw them really sort of racing past their peers for the first annual gain since 2020, since the pandemic. In fact, the CSI 300 climbing about 15%, a gauge of Chinese equities listed in Hong Kong also jumping 26%. So we will see if that sort of optimism when it comes to increased fiscal policy, stimulus measures from Beijing to boost the economy will continue into 2025. We're seeing FTSE A50 China futures there up by just about 0.2%. We are seeing Taiwan futures a little bit softer there, 0.6%. As we spoke about earlier on, we'll be watching in particular BYD and some of those Chinese EV stocks. They could see a bump after BYD saw that year-end surge, pushing total sales to 4.25 million passenger cars. So really narrowing that gap with Tesla and hitting a new monthly sales record in December. So EV stocks in China really one to watch in the session. Still a lot of signs of caution when it comes to Chinese equities, that recent fall in the onshore gauge and also sort of broadly weaker appetite for stock-focused mutual funds. Some of these deep-rooted issues, of course, to sustain momentum are still a question mark for some of the skeptics in terms of Chinese equity investment. That is it for the Asia trade. Our markets coverage continues with the start of trading in Hong Kong, Shanghai and Shenzhen. This is Bloomberg.